Hey everyone! As an analyst for TalkTickers, I get this question all the time. Today we're going to break down one of the most common investing dilemmas out there. So, you just got a windfall. Maybe it's a bonus, an inheritance, who knows? Now you've got this pile of cash and you're thinking, what's the smartest move? Do you invest it all right now or do you kind of ease your way in over time? It's a classic choice, and believe me, the answer isn't always obvious. Yeah, this choice really comes down to two totally different mindsets, doesn't it? It's like, do you just dive headfirst into the pool, or do you dip a toe in to check the temperature first? Let's get really clear on what these two opposing camps are all about. Okay, so here they are, side by side. On one side, you've got lump sum investing. We'll call it LS. It's exactly what it sounds like, right? You take the whole chunk of money and invest it. Boom, all at once. And on the other side, you've got dollar cost averaging, or DCA. This is the more gradual way to do it. You break up that big sum into smaller, equal bits and invest them on a regular schedule. All right, let's get into it. Why does DCA feel so right? I mean, it's super popular, and there's this powerful, almost intuitive pull to it that just makes sense to a lot of us. I mean, the logic behind it seems totally solid, right? You're investing the same amount of money every time. So when prices are low, your money buys more shares. When prices are high, it buys fewer. It feels like this genius, built-in discipline to stop you from doing the one thing we all dread, throwing all your money in right at the very top of the market. Ugh, just thinking about it is scary. Okay, look at this. This table really shows the quote-unquote magic of DCA in action. So in period one, the price is $3. Your $60 buys you 20 shares. Then, oh man, the price drops to just $1. Your $60 now buys you 60 shares. Then it bounces back to $2 and you get 30 shares. Now get this, the average price of the stock over these 3 moments was $2. But because you bought more when it was cheap, your average cost per share was only $1.64. You actually paid less than the average price. This is the core argument you'll hear for DCA, and it looks pretty convincing. But, and there's always a but, isn't there? This is where things get tricky. Researchers like Simon Haley have looked at this and said, hold on a second. He basically argues that this whole beautiful idea might just be a powerful cognitive error, a trick our minds play on us that feels smart but might not actually be the best move. So, okay, theory is one thing, but what happens when we look at the cold, hard data? Let's put the theory on the shelf for a minute and see what decades of real-world market history have to say. Does this feel-good strategy actually pay off? Well, it turns out the data is pretty loud and clear. When you crunch the numbers, we're talking multiple studies, different countries, different decades. One of these strategies wins about 2/3 of the time. I mean, that's a huge edge. That's not a coin flip. And here it is, plain as day. This chart is based on some massive research from Vanguard. And you can see it right there. Lump sum investing, the dive-right-in approach, comes out on top roughly 67% of the time. That's compared to just 33% for dollar cost averaging. And this holds true in the US, the UK, Australia. It's a pretty consistent pattern. So what the researchers at Vanguard are basically saying is, look, historically, markets tend to go up over time. So if you believe that trend is going to continue, the smartest thing to do is get your money exposed to that potential growth as soon as you possibly can. Don't leave it sitting on the sidelines. So the big question is, why? Why does jumping in all at once win so often? It's not just random luck. It really boils down to this classic investing mantra you've probably heard before. It's about time in the market, not timing the market. Think about it. When you decide to do dollar cost averaging, what are you actually doing? You're intentionally holding back cash. You're keeping it on the sidelines. And what is that? It's market timing. Whether you realize it or not, you're making a bet. You're betting that the market will drop soon, so your cash will be more powerful later. This is one of my favorite analyses ever. This guy, Nick Majuli, decided to put this to the ultimate test. He basically said, okay, what if we had a perfect investor? I mean, a literally godlike investor who could see the future and knew the exact bottom of every single market crash, every dip, and invested their money at that perfect moment. And the result? It's absolutely wild. Even this perfect, all-knowing, buy-the-dip genius still ended up with less money over 70% of the time than someone who just invested on the first of every month, no matter what. No timing, no thinking, just consistently investing. And that just hammers home the point, doesn't it? That dip you're waiting for? It might not come for a long, long time. And while you're patiently waiting with your cash, the market is usually just climbing. You're missing out on all that growth, that beautiful compounding effect. The cost of being on the sidelines is often way, way higher than the benefit you get from buying a dip. Okay, so at this point, you're probably thinking, case closed, lump sum is the way to go. But hold on. If the numbers are so clear, why on earth do people still do DCA? Well, because investing isn't just about math. It's also about psychology. And this is where DCA has a totally different kind of value. Let's be real. The main benefit of DCA isn't about making more money. It's about managing your emotions. It helps you avoid that absolutely sickening feeling of regret. You know, that feeling you'd get if you put all your money in on a Monday and by Friday the market has crashed 20%? DCA is like an insurance policy against that feeling. It gives you peace of mind, and for a lot of people, that makes it way easier to actually stay invested and not panic sell. But just like any insurance policy, this one has a premium. You're paying for that peace of mind. And this table kind of shows you what that premium costs. If you look at the data, a 6-month DCA plan only had about a 36% chance of beating a lump sum since 1926. And in the last 10 years, that dropped to just 21%. On average, you're giving up returns. That's the opportunity cost, the price you pay for sleeping better at night. All right, so where does that leave us? How do we take all of this, the math, the history, the psychology, and actually make a decision? What's the final verdict here? Here's the thing. It's not about which one is better overall. It's about which trade-off you are willing to make. It's a choice. On one hand, lump sum investing is mathematically the better bet for maximizing your wealth over the long haul. But you have to be able to stomach the higher emotional risk in the short term. On the other hand, dollar-cost averaging is way better for your nerves. It minimizes that potential regret, but you have to accept that you'll probably end up with less money in the long run. And that's really what it all comes down to. You have to ask yourself, what am I more afraid of? Am I more afraid of missing out on potential gains, or am I more afraid of the feeling of regret from a bad timing decision? The right answer is deeply personal, because at the end of the day, the data can say whatever it wants, but the absolute best financial plan is the one you can actually stick with when things get scary.
And of course, just a quick reminder, this is not financial advice.